Hello. In this video, we'll focus on the Qualified Business Income Deduction, specifically on the planning issues related to the deduction. This is meant to be a continuation of the previous video on mechanics. If you have not yet watched the Qualified Business Income Deduction video on mechanics, please stop the video and go and watch that, because many of the topics in this video are meant to be continuation and they will be referenced from that video. So we're going to focus on 4 major planning aspects, and this video is not meant to be an advanced discussion. It's meant to go over the general overview of where planning is located with regard to this deduction, because there are lots of planning activities, and this is an area where tax professionals do a lot of planning. We'll first focus on activity planning, where we will talk about the specified service trader business versus the qualified trader business, and also disaggregation versus aggregation. We'll then go to entity planning, which is choice of entity as well as potential ways to get maximum benefit from the qualified business income deduction. Income planning, which focuses on qualified business income and making sure to maximize that to get the most benefit for the taxpayer. And finally, deduction planning, which really focuses on wage and property limitation. So let's look at activity planning. When do you meet the criteria of a specified service trader business? So if you remember from the mechanics video, we defined what a specified service trader business is. That's our yellow light type activity versus, or I shouldn't say activity, type classification, versus the green light was the qualified trader business, and then the red light, which you can never get the deduction, was the being in the business of being an employee. So the key, as you might recall from the mechanics videos, is we have 6 situations with respect to the qualified trader business versus the specified service trader business. And you might recall that situations 1, 2, and 3 from the specified service trader business were much more limited with respect to what can be taken versus if you're a qualified trader business. So one of the planning type activities is activity planning, trying to classify the entity as a specified service trader business rather than a qualified trader business, because this can have, again, less limitation with respect to the taxpayer and potentially provide a huge benefit. So just recall that a specified service trader business is defined, and the definition really comes by reference from section 1202 E3 Cap A. Number 1 and number 3 come from that, with the exception of engineering and architecture, which are specifically excluded. Number 2 is added. So number 1 is service providers in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, and brokerage services. Number 3, any trader business where the principal asset of such trader business is the reputation or skill of one or more of its employees. Note that 1 and 3 again come from section 1202 E3 Cap A, except the engineering and architecture, which is from that section, is specifically excluded. And then also there's an added any trader business which involves the performance of services that consists of investing and investment management, trading or dealing in securities, partnership interests, or commodities. That's added in. That's not in 1202, but that's added on there. So if you are in this category, you're considered a specified service trader business, and guess what? You're much more limited than a qualified trader business, as we saw in the mechanics videos, based on the 6 situations. So really, the activity planning comes into play, or issue comes into play, well, in twofold. First is, what if you're borderline? Is there a way you can argue whether you're a specified service trader business but you're not, but you're actually a qualified trader business? And the second is that if you are a business with multiple potential income from activities, maybe you can try distinguishing that some activities are specified service trader business and others are qualified trader business. And that's really where the activity plan comes in. This is one of the biggest areas. So I just want to bring light to 3 real issues when it comes to determining what exactly is a SSTB. So the first thing is, I mentioned that there's this language, a specific carve-out language of section 1202 E3 Cap A. And really, to go a little bit further, because I've mentioned this many times in the mechanics videos, I mentioned it already in this video, if you look at section 199 Cap A, the Qualified Business Income Deduction, it specifically references specified service trade or business as those activities in 1202E3 Cap A with the exception of engineering and architecture. And then again, it lists the investing and investment management, trading or dealing, blah, blah, blah. Number 2, as we saw in the previous slide. So one thing to note is that by referencing 1202E3 Cap A, if you go to code section 1202E3 and you look at A, well, there it is. There's the language that we see. Any trade or business involving the performance of services in the fields of health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of such trade or business is a reputation or skill of one or more of its employees. So that's the exact same language that we saw before in number 1, number 3, with the exception that engineering and architecture are excluded under section 199 Cap A Qualified Business Income Deduction, and they're not excluded from this definition in 1202E3 Cap A, right? It says law, engineering, architecture. Those are taken out for 199 Cap A purposes. But look at 1202E3 B, C, D, and E. B says banking, insurance, financing, leasing, investing, or similar business. Now, investing, we know from our definition that investing in investment management and trading or dealing in securities, that is a specified service trade or business. So you can't say it's not a specified service trade or business because that was specifically put in there. But what about something like banking? Is banking considered a specified service trade or business? Well, because they reference in section 199 Cap A 1202E3 Cap A, and they don't say 1202E3B, and then in number 2, there's nothing to do with banking, it's about investing. That means that the banking industry is considered a specified service trade or business. Now, most banks are operated through C corporations, and as we know, C corporations do not get the deduction, but there is a very small lobbying group called S banks, S corporation banks, that might potentially get this. Also, look at any business of operating a hotel, motel, restaurant, or similar business in 1202E3 Cap E. We'll notice that that wasn't referenced with respect to the specified service trade or business. Again, only E3 Cap A. So that means that that stuff is okay. Hotel, motel, restaurant, or similar business. But if we look back our definition, what about the reputation or skill? So where I grew up, there's a very famous Latin singer, and the Latin singer built a hotel on the beach. Many people would go to the hotel just because they knew that the owner was this Latin singer. Now, is that because the trade or business or the principal asset is reputation or skill? Well, that's an argument you can make. But 1202E3 Cap E says any business of operating a hotel, motel, restaurant, or similar business. Well, that's not specifically in the specified service trade or business. So I would argue that because those other areas were left out, 1202E3B, banking, insurance, farming, and then E, you have hotel, motel, restaurant, or similar business. I would argue those are not specified service trade or businesses because they were not specifically referenced, and the language in that was specifically referenced actually says 1202E3 Cap A. If you don't believe me, go look at Internal Revenue Code section 199 Cap A. It says they specifically reference, they actually use the phrase 1202E3 Cap A. They actually use that. So that's the first thing I want to mention. The second thing is, so the specified service trade or business is really meant to get at, if you look at the definition, it's really meant to get at service businesses. When you have things like consulting, accounting, law, health, you're talking about very purely service-based businesses. And if you look at the other areas of the definition, you'll notice it's very service-based with not much goods. Well, hybrid cases. What if you're doing something like some type of engineering / consulting, I should say, product consulting, where you deal in products and goods? Well, in hybrid cases, I would argue that the specified service trade or business does not apply because you can make a good argument that this is a qualified trade or business because you're not dealing solely in services, purely services like health, law, accounting, but you're dealing in goods as well. So that's another thing to mention. The third thing I want to mention, and this is a big issue, is the reputation or skill catch-all. So many people, when this provision first came out, were horrified because they said any trade or business where the principal asset of such trade or business is a reputation or skill of one or more of its employees. That captures almost every business out there. If you have a very broad view of that, it captures almost everything. If you have a narrow view of that, then that's not the case. For example, I mentioned that there's that hotel, right, where the owner is a very famous Latin singer. Performing arts is mentioned in the first one. Are people going to this business because of the reputation of the performing arts singer? I would argue that mainly a lot of them are going to that hotel. But again, with the carve out of 1202E3 Cap A, and then we saw 1202E3E, hotel, motel, restaurant, or similar business, you make a strong argument it's not included. But can you say, okay, well, people are going to that hotel, motel because of the number 3, the principal asset, the reputation or skill of one or more of its employees? You could make that argument if, again, it's viewed as a very broad, number 3 here is viewed very, very broadly. So that's very important. I would say that it's viewed very narrowly, okay? If it is viewed narrowly, then really what you're going to see is that this isn't that big of an issue. Again, this is meant to be a basic discussion, so if you do have an issue like this, you need to go further into this issue, because this could be potentially a big issue. Now, if you remember in the history discussion I had in the mechanics video, I mentioned the House bill. And this part was actually in there, that any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. Well, actually, the House bill, in the explanations, they actually referenced Stephen Curry from the Golden State Warriors, and they basically said that Stephen Curry can't get this deduction because the reputation or skill issue applies to him. If you recall the definition, you see that service providers are in the areas of health, law, accounting, actuarial science, performing arts, consulting, athletics. Obviously, Steph Curry is in athletics. If Steph Curry creates an LLC and he's the sole owner and all his business flows through that as, operating, his MBA career, well, that's athletics. So that would be a specified service trade or business. But what about the money that he gets from Under Armour with regard, or at least the time of this video is Under Armour, could change in the future, right? These things change all the time. What about that? What about the endorsements? I mean, he's getting $35 million in 2017 from endorsements and only $12 million on the court from the actual NBA team. A lot more off the court, right? Well, the House pretty much said that no, can't get this because of that reputation or skill. The whole reason that he's getting these endorsements are because of his reputation or skill in the athletics, with respect to athletics. So that's an example with respect to what they were meaning. So what do you really think, Steph? I think that he cares more about, making sure that he wins more NBA championships. So that really goes over the specified service trade or business items. The next thing I want to talk about, and this continues with activity planning, is aggregation versus disaggregation, which when this provision came out, many academics and professionals were calling it cracking versus packing. Really what the idea here is if you have a type of business, it's possible you might be able to disaggregate one of your service lines or one of your businesses that might be viewed as not a specified service trade or business, or might be viewed as, okay, well, certain employees might not be subject to the taxable income thresholds. So I'm going to walk you through 3 examples that we can look at, okay? So the first example deals with, let's say we have a law firm. Okay, you have a law firm. And the law firm, let's take a big law firm in New York City. How about Sullivan & Cromwell? Sullivan & Cromwell is one of the big law firms, and they pay their associates, their starring associates, a ton of money. A starring associate would be already, with the bonus, already above the income threshold numbers, okay, with the bonus. Starting salary plus signing bonus plus, likely to get the normal bonus during the year, already over those threshold numbers. This is in New York City as well, okay, over the threshold plus if you're single. Okay, let's say they're single. Well, that's for the attorneys. What about the paralegals? So paralegals might not be at that threshold plus level that we talk about in the situations, right? Because a law firm is obviously a specified service trade or business. So we're looking at situation 1, situation 2, situation 3. And again, the attorney would be above the threshold plus, which in 2018 was $207,500. It's again inflation adjusted, so depending on your year, you need to look at that. but the attorney is already over that for taxable income. So the issue becomes, if they were a shareholder in the company, an owner, because you'd be an owner, right? They wouldn't be able to get it because it's a specified service share business and they're above the threshold plus. Obviously, the partners of Sullivan and Cromwell are making their taxable income is well above this amount of income, right? Well above. So what about the paralegals? Well, the paralegals might not be above that threshold plus, so they might be able to get the benefit. So let's say that a group of employees at the law firm, the paralegals, they disaggregate from the law firm. So they leave the law firm as employees. Then the paralegals get together and they form their own business as owners. And they specifically do paralegal work just for that firm, Sullivan and Cromwell, in New York City, that big law firm. Well, they're owners. They're not a C corporation. Let's say they form an LLC or an S corporation. So it's not a C corporation. It is a specified service trader business, and they are below the threshold plus. So they're either situation 1 or 2, let's say, married, filing, joint, or single. So they can potentially get the benefit, but because of remember the 3 situations, you're being in the business of being an employee. Well, Treasury pretty much sees this as, okay, you're in the business of being an employee because that paralegal group, that firm they created, that LLC they created, that business they created, only does work for Sullivan and Cromwell. So yes, they left the firm as an employee, but they still indirectly are still its employee by only performing paralegal services just for that Sullivan and Cromwell. Now, if they were doing it at multiple firms, then it wouldn't be an issue. But if they're doing it just for Sullivan and Cromwell, then that would be an issue. So this wouldn't be allowed. The paralegals would likely not be able to take the QBI deduction because it'd be viewed as them being in the business of being employed, which is very similar to the rationale under Code Section 269 Cap A in the Internal Revenue Code. So that one doesn't work. What about another example? Let's say we have, okay, Sullivan and Cromwell, they own their building in New York City, which is actually very interesting. So they own their actual building. What if the owners of Sullivan and Cromwell decide to disaggregate the building and put it in a different ownership, let's say an LLC, and the same owners of Sullivan and Cromwell, the same partners, they're going to own the LLC that owns the business, the real property, at the same percentage. Well, if they're managing the real property continuously and regularly, it's viewed as, okay, they're in the trader business of the real property, and it's a very big building. So if they rent it to Sullivan and Cromwell, the firm pays interest. Sullivan and Cromwell can deduct the interest, and then the income has to be reported by the owners of the firm that owns the building, which is the same owners as Sullivan and Cromwell in the same percentage, but they get a 20% QBI deduction, potentially, okay? Because they'll be in a qualified trader business, remember, and since they're a qualified trader business, and let's say that all the owners are above the QBI threshold, they're very likely, since they're partners or owners of one of the biggest law firms in the world, they're going to be in situation number 6, so they get 20% of QBI, but they're also limited to the wage and property limitations, which if they own that building is worth many millions of dollars, so they shouldn't have to worry about the QBI limitation because they can use that property. If they're putting improvements and whatnot on it, then they can continue to use that stuff in the basis of the item, of the building. So that potentially can give them that type of deduction. So is this allowed? Can this be taken? Because do you see where the benefit is? The benefit is, okay, the partners, they get a deduction at the Sullivan and Cromwell firm level because they're paying rent. So that lowers their taxes. It gets allocated out to the partners. And then the income, the partners have to include income, but they also get the QBI deduction, the Qualified Business Income Deduction, 20% deduction off the income they get, so it's actually taxed at a lower rate. So the Sullivan and Cromwell deduction for paying the rent, that's going to lower them at the highest ordinary income tax rate, but then the income they report is going to be lower tax rate because of the deduction. So this creates like a tax arbitrage where you get a benefit. Is this allowed? Well, actually, I would argue that this is allowed because the idea here is a lot of people do this. They own a building and they lease it or rent it out to one firm or, there's only one building here. They can only lease it to one specific, firm. Versus in example 1, right, the paralegals, they could work for multiple companies, but they only worked for Sullivan and Cromwell, so they weren't allowed to take it. Versus in example 2, there's only one building, so you can only really lease to the one firm. Now you can lease to other firms, but you might only be able, it seems like you're only likely able to lease it just to Sullivan and Cromwell. That's the idea. So in this example, example 2, it's very likely that this will be allowed. This will be allowed. So example 1, where we had the paralegals, you can't take that QBI deduction when you do this type of creative accounting and creative planning and whatnot. Example 2, very likely you would be able to. Now again, you gotta make sure you're qualified trader business, so you gotta have managers, you gotta be actively dealing with the real estate, which likely is. It's a huge building in New York, and you look it up. What about somewhere in the middle? So example 3 says, what if Sullivan and Cromwell basically disaggregates some of its groups, like bookkeeping, billing, into separate entities. And then the separate entity does the work only for that firm. So it's somewhere in the middle. It's not exactly the same as the paralegals, because you're dealing with the, it's not like a bunch of people are getting together, it's the firm actually is doing it. So it's somewhere in the middle, right? In example 2, the firm broke off the property. In example 1, the employees, they got together. That's what the distinguishing fact is. Example 3 is somewhere in the middle between example 1 and 2. I would still argue, though, that in example 3, where the firm disaggregates various support groups, like bookkeeping, billing, into separate entities to try to get some type of benefit out of that, and argue that maybe it rises to a different level of qualified trader business, I would say it really depends on the circumstances. This is one you're going to have to look more into. So those are really the 3 types of major, and there's other types of examples you probably can think of cracking versus packing, disaggregation versus aggregation. Another major thing is grouping. So what if you're a business, and you do you have different types of activities that you do, and you potentially could separate out different activities, different lines, and argue, okay, one line is a specified service trader business, and the other is a qualified trader business. Is this allowed? Okay, so that's really what's going on here. We're separating activities to maximize the impact of the qualified business income deduction. Because if you're over that threshold plus amount, situation number 3 for the specified service trader business, then guess what? You're not going to be able to take the deduction. But on the for whatever is classified as qualified trader business, if you're in situation 6 and you're above the thresholds, you can take that. So it makes a big difference. So some examples deal with, okay, well again, if you are able to if you own a building in your business and you're able to argue, okay, well, I rent that out to the business, you could separate that out, okay? Now there's a question of whether it has to be an actual legal separate entity versus just part of the business. That's something for you to look into. Again, this is just a basic discussion. I would say that the best thing to do is put it in a separate legal entity and make sure that it's in that, okay? So separating the activities can help that as well. So here's an example. So a medical doctor with taxable income exceeding the phase-out threshold, right? And again, medical services, healthcare, so it's specified service trader business, splits his medical activity into a medical activity and a non-medical activity. So maybe this medical doctor is a dermatologist and maybe sells face cream, which the face cream is viewed as a good and not a specified service trader business. Maybe creates the face cream or something, has like some type of, formula that he puts together for the face cream for dermatology. And maybe selling the face cream is viewed as non-medical, but then treating the clients, patients, and obviously doing the health-related services as a specified service. So if he can separate, these activities, the non-medical activity is not going to be entitled to the deduction, but the non-medical activity is going to be entitled to the deduction because it's a situation number 6 versus the medical activity is considered a specified service trader business, and you're not going to get the deduction because it is a specified service trader business. So that's a big, big distinction. Here's another example which deals with rental. So landlord has a rental property with annual losses. Landlord ensures that he has sporadic activity involving the rental property. Here's an example where a landlord dealing in rental property wants to make sure it's not considered a trader business and it's considered sporadic, so it doesn't meet the level of trader business, because landlord wants the rental losses, which are not to be incurred with a qualified trader business. That way it doesn't reduce the qualified business income. Because remember, if you have one of your businesses has a loss, it has to offset the other areas of business. So if there's one specific area that's a loss, that has losses every year, you want to try to make sure that's not going to be a specified, that's not going to be in the computation with respect to all the different trader businesses. So if you argue it's sporadic, which is investment activity, it doesn't get the QBI deduction because it does not rise to the level of trader business. Which, remember, from the mechanics video, we have that flow chart. You have to first ask, do we own and operate a trader business? So if it's sporadic activity here, which we have here, it's investment, does not qualify. So see how it's a very interesting topic. Okay, see how that works? So here, this loss activity, because it's sporadic, would not taint the other trader business activities of the landlord, which do create a positive or a net income, which the landlord can get the 20% QBI deduction. So this is an example, again, of maximizing the QBI deduction, which is what all this really is just maximizing QBI deduction. So entity planning. As I mentioned in the mechanics video, I talked about history. And the big push for why we have this provision, in a little nutshell, is because the corporate tax rates were reduced. They reduced dramatically from 35 to 21% under the Tax Cuts and Jobs Act of 2017, starting in 2018. And this provision was the level of the playing field for the pass-through, flow-through entities. That's the idea. So before the Tax Cuts and Jobs Act of 2017, business entity planning, or choice of entity, was very, very, very basic, and it was very rare to find a time when you needed a C corporation. There were some instances where, okay, well, if you retain earnings, don't have to worry about the accumulated earnings tax, because the corporate tax rate is lower than the highest ordinary income tax rate. You could potentially save taxes there. Also, maybe you step up basis type rules with 1014 estate planning concepts with respect to the retaining your earnings in the corporation. Also, financing, because some types of venture capital angel investors prefer you to be in a C corporation, so you can, so it's easier to get financing, and it helps them out with respect to tax issues. Those are the kind of reasons why you might take advantage of a C corporation over S corporation or LLC. Well, after the Tax Cuts and Jobs Act of 2017, with a lower C corporation tax rate, very much lower, C corporations become very enticing. But remember, the Qualified Business Income Deduction under Section 199 Cap A, what we're talking about in this discussion, was enacted to level the playing field. So a lot of times, it still makes the most sense to operate as an S corporation or LLC, because you can still get that Qualified Business Income Deduction. Now, if you're in an area where the Qualified Business Income Deduction is not going to be maximized, maybe because you don't meet the wage and property limits, but you know you're going to be in that category, like situation number 6 for a qualified trader business, but you know you're not going to be able to plan around that because you lease property or something like that, or you don't have any employees, then maybe it is best to go in a C corporation, because you do get the 21% rate versus the 37% ordinary income tax rate, and you don't get the Qualified Business Income Deduction. But if you can get the Qualified Business Income Deduction and you can maximize that optimally, which we'll talk about with the deductions, with the wage and property limits, some ways to do that in income planning, it makes the most sense to stick with the S corporation or LLC. Not everybody, but most of the time, you're going to see after the Tax Cuts and Jobs Act of 2017. So really, after the Tax Cuts and Jobs Act of 2017, it still is the same result. A S corporation or LLC is usually the best result, because you can always change to a C corporation with not many tax consequences in the future, versus going the other way. Switching from a C corporation to S corporation or LLC is very difficult. After the Tax Cuts and Jobs Act 2017, S corporation and LLC are very enticing still, but I will say that after the Tax Cuts and Jobs Act of 2017, with the corporate tax rate being lowered, you do have to dive deeper into the business to see what's going on and make sure that the QBID, the Qualified Business Income Deduction, can be maximized to get that benefit. So there's also some entity planning dealing with respect to the taxable income limit. Maybe a taxpayer could put certain activities into a C corporation, because the taxpayer knows that if those entities are in an S corporation or LLC, they would be allocated to the taxpayer, and they would increase the taxable income for the year, because remember that S corporations and LLCs, they're allocated. Their income is allocated, or deductions are allocated, losses credits, all those things are allocated each year, even though the taxpayer doesn't necessarily receive those items. They're just on paper, but they're allocated and they're taxed at the owner level. Okay, they flow through to the owner level. Versus a C corporation, yes, the C corporation pays tax, but it's a much lower rate now, or at least in 2018 it is, could change in the future, than what individuals pay. So that's a big issue. Okay, so you can actually lower the amount of taxable income because the flow through could potentially, if you do have income from a business entity, that could raise the taxable income. But if you have that in a C corporation, you could time it so that none of that taxable income comes into your taxable income calculation because it's separate. It's in the C corporation and it's not part of your taxable income determination. And we're talking about those phase outs for the taxable income back in the entities. In the mechanics in the 6 situations. So that can make a big difference if you're trying to figure out how can I reduce my threshold so that I can get the QBID if I'm a specified service trader business. These are ways to do that. Okay. So one thing with entity planning is that specified service trader businesses probably belong in an LLC. It's probably the best case when you're looking at the qualified business income deduction. So I want to illustrate through an example. So assume we have accountants X, Y, and Z. And accounting, as we know, is a specified service trader business. And they want to form a new accounting firm and they want to maximize the likelihood of qualifying for the qualified business income deduction. So assume that in 2018, they're calendar year taxpayers, let's say, the firm expects to distribute $1 million, or it's allocated out, I should say. It's allocated, distributing cash, but it's also allocated. These amounts are allocated. $1 million in 2018. So they have $1 million in income that's allocated out. And X will be allocated $500,000. Y and Z, though, will each be allocated $250,000. So $500,000, $250,000, $250,000, $1 million when you add those up. Now, X and Y are married filing joint with their spouses. Z is single. So assume someone artificially that they're only service providers in the business. They're the only ones, okay? They're the only 3 service providers in this accounting firm. And that there's no W-2 wages paid. All right, that's very important. So they choose to be an S corporation, then X, Y, and Z, under the rules for S corporations, for reasonable comp for corporations, you're going to be required to make some type of compensation payment, a reasonable amount to each owner, to X, to Y, and to Z. Okay? Now, what that amount is determined based on the facts and circumstances. We're not going to go into that. But the important point is that there will be some type of compensation that has to be taken out. And if you remember from our mechanics discussion, the previous video, the amount of qualified business income, right, which is what creates the deduction, right, 20% of the qualified business income. Well, the amount of qualified business income does not include W-2 wages paid to the taxpayer. So the amount that X, Y, and Z are deemed to have reasonable compensation from the S corporation, if they choose to be an S corporation, that would not go in qualified business income. However, if X, Y, and Z choose to be an LLC, well, guess what? LLCs, under the partnership tax rules, they actually cannot pay any W-2 wages to themselves. They're generally barred by the IRS rulings from being employees of a partnership in which they are partners. So there will be no W-2 wages paid, right? And they don't have any employees, so they can't pay wages to anybody anyways. And remember that guaranteed payments don't count as well. But let's say there's no guaranteed payments, there's no W-2 wages in LLC. So what ends up happening is this increases the amount of qualified business income for X, Y, and Z. So if we continue with that reasoning, continue with the choice of the LLC, then what you're going to see is that X, because X is married, filing joint, and has $500,000 in partnership income, likely X will exceed the maximum threshold amount of $415,000 in 2018, depending on your year. So therefore, X, because it's a specified service trader business, X won't be able to get the deduction. Same thing for Z. Z is single, and Z gets $250,000, which is likely more than the maximum threshold, which in 2018 is $207,500. Again, inflation adjusted in the future when you're watching this. So X and Z can't get the deduction. But what about Y? Y gets $250,000, and let's assume that Y's spouse doesn't really have much additional income. Well, the threshold amount was $315,000, the initial threshold, and because the initial threshold is $315,000, then Y can get that deduction and of 20%. So operating through an LLC, Y gets to maximize the QBI because that $250,000 of QBI, we take that times 20%, which is $50,000. If this was an S corporation, and let's say that Y was deemed to pay through the reasonable compensation rules $100,000, it would only be $150,000 times 20%, which would be $30,000. So that makes a big difference. Okay, that makes a big difference. So so you're talking about $30,000 versus $50,000 in terms of operating through an LLC. Makes a big difference. Big difference. And if you're looking at multiple years, that's obviously, if Y, let's say, has an effective tax rate on that amount of 30%, you're talking about saving each year about $20,000 difference, $30,000 versus $50,000. So $20,000 times, let's say, effectively again 30% tax rate, talking about $6,000 savings in taxes each year by getting the deduction. The difference between, I'm talking about the difference, not the actual, the $50,000 times 37 would be $15,000 benefit to Y. But I'm talking about if it was an S corporation, and again, let's just say Y had reasonable compensation under the rules, under the rulings to be $100,000, well then only $150,000 would be qualified business income. $150,000 times 20% would be $30,000. So that $20,000 difference, 50 for LLC versus 30, $20,000 difference, multiply that by 30% tax savings, tax rate, that would give a $6,000 benefit. And if, again, that can go for many years. That could go for 20 years, talking about $120,000. So that's why being an LLC for a specified service trader business makes a big deal. Because, and the reason for that is because with an LLC, you can't pay yourself wages. So if you recall, if you're a qualified trader business, you want wages because of the wage and property limitation, right? So if there was a, and this potentially could get into a negotiation as well. If this was a qualified trader business, Y would want to be an LLC, but X and Z would want to be here an S corporation, because their amounts would be above the threshold plus amounts, and then they would want deemed compensation through an S corporation, so that way they could get the benefit of the wages for their allocable share, so they could maximize the amount or at least get some deduction. Do you see how that works? This actually creates a negotiation issue, very interesting negotiation issue. All right, so let's continue on. So that's really the entity planning, and that's, again, you can see all sorts of issues there. I thought that was really interesting, where that, if it was a qualified trader business in that last example, how X and Z would want to be an S corporation because of wages, and Y would want to be an LLC because because Y. So X and Z want wages because of the wage and property limits because they're above, but Y would not want to be an LLC because they don't want any wages and they want to make sure they maximize their QBI. So see how that works? Very important item there. The income planning issue. We're talking about maximizing your qualified business income. We just saw some examples of that. So you need to make sure that income is qualified business income and review documents and whatnot. You want to avoid guaranteed payments if you're a LLC, a partnership, because those portions don't count towards QBI. And then delaying the receipt of non-QBI types income to avoid phase-outs. Because remember, taxable income is what determines those situations. And if you can try to delay those into the next year, you might be able to get the QBI in 1 year, but maybe not the next year, which is better than not getting it in 2 years. So here's a little example dealing with the guarantee payments, or some type of, not example, but just a little tidbit. Taxpayer is a partner in a partnership. Rather than receiving a guaranteed payment, which does not qualify as QBI and are not wages, which, for the item, the partnership pays amounts to him as part of his distributive share, which does qualify for the qualified business income deduction. So the distributive share is, those items of allocable income, gain, loss, deduction to that taxpayer. If you put it through the distributive share, the normal allocation, then that actually counts towards the QBI, versus paying a guaranteed payment does not count. So there's going to be lots of issues where LLCs and partnerships are now going to try to, get around the guaranteed payment rules. I mean, they can't pay wages, but they can pay guaranteed payments. So that's going to be important. All right, so the last type of planning is deduction planning. And this is one of my favorite areas of planning because this is where you can really see it's the, some of the other stuff you just saw might take you a few times to re-listen and read the slide. The deduction planning stuff, if you watched the previous video, which again, if you haven't, I recommend you stop and go watch that on mechanics, you should be able to see deduction planning. It's a lot clearer, especially with the wage and property limits. So accelerating non-QBI types of deductions to avoid phase-outs. So on the flip side of the income planning, where you might want to defer into the next year non-QBI type income, you want to accelerate non-QBI types deductions to avoid phase-outs to lower your taxable income. Okay? Paying bonuses to employees before the end of the year to maximize wages. So a lot of companies, they pay bonuses at the end of the year, which that's fine. If you pay more in bonuses, if you're getting close to year end, you're saying, okay, well, our wage limitation numbers are low. You could pay a bonus that year to your employees to maximize the wage limitations. And we'll talk about how you can maximize. There's some factors you can use to do that, okay? And remember, if you recall from the previous video, the mechanics video, to count as W-2 wages, you have to file within 60 days of the filing date of the return and all that stuff with the Social Security Administration. So make sure you meet those specific requirements. And then remember also that it's not just wages, but also property qualifies. You can purchase equipment in one business to reduce overall taxable income, where it will help create the QBID in other businesses. That's very helpful. Now, as you might recall from the mechanics video, you have to actually place it in service in that line of business, but that might be able to help you with respect to other businesses or lower your overall taxable income, okay, for the thresholds. So there's lots of things going on. So here's an example with the bonus. So taxpayer pays a critical employee a bonus at the end of the year to increase W-2 wages to meet the 50% requirement, right? Let's say they're in situation number 6, they're a qualified trade or business, and and they don't have it. They have lots of QBI, and they want to get 20% deduction on that. This taxpayer does, but they have some issues with wages. So they pay one of their employees, and they meet all the requirements of 60 days Social Security Administration. They pay one of their critical employees an end of the year bonus to increase that. So whatever amount you pay that bonus, you get a 20% benefit. And obviously, the employee loves you because you're paying a bonus at the end of the year, and the more you pay, it's going to help you out. So those are the kind of things that help go into deduction planning. Wage planning. So there's temptation for taxpayers to underpay W-2 wages to themselves, not only in order to reduce Social Security and self-employment taxes, but also to enhance the amount of QBI deduction. Because remember, wages and guaranteed payments do not count towards the QBI deduction. So wages, you might want to lower that. Significantly, a partner in a partnership cannot be paid W-2 wages by the long-standing, we talked about this, the revenue ruling or the rulings, and therefore, there's also other rules that relate towards that, and therefore an individual operating through a sole proprietorship or a partnership would be able to maximize QBI. Okay. However, if you're the only business owner, if you're the only employee of your business and you're in a single member LLC or a sole proprietorship, and you're situation 6, a qualified trade or business above the threshold amounts, and you cannot pay wages or you don't have any property because you lease it, then your wage and property limits are going to be 0. So you got to pay attention to that. So again, this is kind of double-edged sword. Double-edged sword, sorry. I said edged. Double-edged sword. It can help you in one side because being an LLC or sole proprietorship, it can increase your qualified business income amount that you get the deduction on, but it can also hurt you because if you don't have enough employees that you pay wages to and you don't have any qualified business income and you get stuck with the wage and property limits, that potentially can really hurt you. So good configuration for a partnership or sole proprietorship is to actually have employees who work for you, or you have some type of that generate W-2 wages, and again you go through all those hoops, or you have a substantial purchase of business property for the year. But remember, that's 2.5% versus the W-2 is 50% of W-2. So wages have more powerful impact. Really, the purchase of the business property, that was really to get towards like real estate and those types of activities. Real estate does qualify for this deduction as a qualified trade or business if it's considered a trade or business. That's very important to understand. Okay, so this demonstrates that its optimal strategy for a particular business will depend on the nature of that business the amount of the good income, the QBI income that it will generate, and whether it has successful mathematical relationship between the good income and the wage and property limits. So I pretty much have already said this. This is just putting it in words. Really what we're talking about here is, if you're an LLC or a sole proprietorship, you can't pay yourself wages. But if you have employees, you can pay your employees and you'll have an allocable share of what you pay through your distributive share. But if you're a LLC or S corporation, you don't have any employees, and you need the wage and property limits and you don't have any qualified property, then you're stuck. So that's just really the idea. It's kind of this relationship that makes it very interesting. And that's why this is a very powerful planning area. So let's talk about the optimal sweet spot for wages. It's really a 2 to 5 ratio. So let's take an example, okay, with an S corporation, okay. So we have Taxpayer Smart has a qualified trader business, which is not a specified service trader business, in which he is a sole person employee providing services. Taxpayer Smart decides to operate through an S corporation, which is smart because remember, if it was an LLC, then Taxpayer Smart can't pay any wages to himself under the partnership rules. Same with sole proprietorships. That's the idea. But an S corporation, you can. And you can actually pay, again, it's a reasonable amount. So the business generates $700,000 of QBI before Taxpayer Smart determines how much to pay himself as W-2 wages. So the end of the year, that's when Taxpayer Smart decides to pay himself wages at the very end of the year, again, but meeting all those guidelines for what W-2 wages count as for the wage and property limits. Now, obviously, this is a qualified trader business. Taxpayer Smart owns it. It's not a C corporation. It's an S corporation. So we're going to be in situation 4, 5, or 6. $700,000 generating a QBI, that means that Taxpayer Smart's taxable income is very likely to be over the threshold plus amount. So we're in situation number 6, where it's 20% of QBI, $700,000, but limited by the wage and property limits. So if we applied it right here and there was no W-2 wages or property, then the QBI deduction would be 0, okay? Would be 0, because if Taxpayer Smart were less smart, then he would not pay himself any wages, even though he can under S corporation, and there would be 0 in W-2 wages, and therefore the QBI deduction will be 0. However, Taxpayer Smart, again, at the end of the year, has yet to decide how much he wants to pay himself in wages. So there's an optimal ratio here you can apply. It's a 2 to 5 ratio. So, and I've used very, whole numbers here. So if we apply the 2 to 5 ratio to the 700,000 QBI, the Taxpayer Smart pays a 200,000 in W-2 wages. So we take 2 to 5 of 700,000, right? So 200,000 of the 700,000 will be W-2 wages. 500,000 of the 700,000 will be QBI. So this leaves 500,000 of pass-through income on his K1, okay? That gets reflected from the S corporation to the actual 1040. If we calculate the qualified business income deduction, and it's the lesser of the 20% of QBI or the wage and property limit. So 20% of QBI is 20% of the QBI, which is $100,000, right? 20% of 500,000 is 100,000. And then the wage and property limit is the greater, which is going to be the 50% of the W-2 wages, which is 50% times 200,000, 100,000. Notice that they're both equal to 100,000. This is where it's optimal. So if Taxpayer Smart pays any more compensation than $200,000, then the QBI amount gets reduced, the qualified business income amount, and it's not as optimal anymore. This is the optimal amount right here, doing $200,000 and $500,000 of QBI. So it's a 2 to 5 ratio. Now, obviously, you're probably wondering, well, I know S corporations and there's reasonable comp rules, and you're right. But if 200,000 is a possible number, then do 200,000 because there are ranges in the reasonable comp rules. So Taxpayer Smart's QBI deduction is $100,000 here. So qualified property also has some optimal rules as well, because that's a mathematical formula as well. Before we go into the optimal formula, assume Z is an individual taxpayer who has taxable income of $500,000 and earns $400,000 of Schedule C income, which is sole proprietorship, and conducting a widget-making business. So obviously, this is a qualified trader business since it's a widget-making business, like a factory. We're over the threshold plus amount because taxable income is $500,000. So therefore, we're in situation number 6. So it's 20% of QBI, which is $400,000, right? The $400,000 in Schedule C, but also limited to the wage and property limits. Well, wages, sole proprietor, you can't have compensation here to the owner because it's a sole proprietorship under the rules. But if taxpayer Z is buying a widget making machine for $1 million and places it in service on December 2018, which is the end of the year, which is as long as it's placed in service during the tax year and it's related to that type of business income, it qualifies. The business has no W-2 employees, and again, it can't pay taxpayer Z any wages because it's sole proprietorship, right? That's the rule for sole proprietorship and LLCs under the current rule, under those rules. So the only thing that helps here is having that $1 million purchase of the widget making machine. So again, we apply the lesser of the 20% of QBI, which is 20% of 40,000. 20% of 400,000. That should be 400,000 there. Sorry about that. That should be 400,000. So 20% of 400,000 is 80,000. And then the wage and property limits, 50% of W-2 wage is 0, plus 25% of W-2 wage 0, plus 2.5% of the million, which is 25,000. So here we didn't have a maximum optimal amount because we could get to 80,000 if we could purchase enough, but maybe taxpayer Z doesn't have enough. So here, rather than get 0 of QBI deduction, taxpayer Z gets $25,000. And that equipment is going to create 10 years worth of benefit. So you can do $25,000 for 10 years, okay? Keep going and you can do $25,000 in 10 years. Unless, the situation changes where they're in situation number 4 instead of situation number 6. Okay, so what is the sweet spot for qualified property? If you're purchasing property, it's a multiple of 8, which is the 2.5% item. So let's just say we have a large landlord, owns many pieces of property, has $500,000 of net rental income, which is QBI income, reported on Schedule E, and has taxable income well in excess of $1 million. So we are, and this is a qualified trader business, let's assume, because this large landlord is actively managing it continuously and regularly. So large landlord is in situation number 6, qualified trader business. It's a Schedule E activity, which is viewed kind of like a sole proprietorship activity. And large landlord is having to report that as a flow through. We have QBI income of $500,000, taxable income well above $1 million. So therefore, situation number 6. Now, large landlord does not pay himself a W-2 wage or doesn't pay anybody W-2 wages, just so you know. Assume the property was purchased in, there's a property purchase that's being rented out for $4 million in 2004, which the amount was the unadjusted basis, and currently has a $2 million adjusted tax basis and fair market value of $10 million. Well, all we care about is the unadjusted basis of $4 million. That's what matters at the time purchase. By the way, that's unadjusted basis at the time purchase. So if we do our calculation, you'll see it's the lesser of the 20% of QBI, which is 20% of the 500,000 QBI, which is $100,000, or the wage and property limit, and that's the greater of 50% of W-2 wages, which is 0 because there's no W-2 wages, or 25% of W-2 wages, 0 plus 2.5% of the unadjusted tax basis of the building, which is 2.5% times $4 million is $100,000. So we get exactly $100,000. So this shows you that it's a multiple of 8. Okay, this is where 100,000 equals 100,000. So if a large landlord was buying a building, didn't have a building here and wanted to buy it, the large landlord should buy a building for $4 million looking at the QBI deduction because it optimizes it. It's exactly the amount. Any more would be, no benefit because you're not going to go over. Now, in the future, it could provide benefit. So with wages, it's a little easier to adjust versus property, not as easy to adjust because you're always stuck at that unadjusted basis, the amount purchased at $4 million. So you see that? So wages are probably going to be the way to go with respect to planning, but property can make a big difference for, again, areas like real estate where there's not much W-2s paid out, okay? You can always W-2 pay, managers of property and whatnot, which is probably going to be needed for active trader business. So that is the multiple of 8 example. So this illustrates that multiple of 8. What I mean here is if we take 8 times the QBI income, 500,000, we get 4 million. So 500,000 times 8 is 4 million, and that's where it's exactly equal. 100,000 equals 100,000. So I hope that you've enjoyed this video. Again, this really just goes through some of the basic ideas behind what's the planning in the Qualified Business Income Deduction, just to give you, just an understanding. Obviously, there's more sophisticated structures out there. I recommend you take a look at those things because they'll help you, because this is a very big area in tax. All right, so I really hope you enjoyed this video, and I hope that this helps you understand more how the Qualified Business Income Deduction works as well.